Welcome to TSAT. As part of Indian economy, we started discussing about public finance, and there are two parts of public finance has been completed. In the first part, we discussed about what exactly is public finance and fiscal policy is all about. So we ended up simply saying public finance is a subject that deals with income, expenditure, and the debts of public debt. That's it. Okay. So in the process of understanding public finance, we started simply looking at the budget sheet and trying to understand budget. We have seen the receipts of the budget, we have seen the expenditure of the budget, expenditure part of budget, what constitutes the receipts, what constitutes the expenditure, what are the different types of receipts and expenditure, revenue, capital, and we have seen various examples. And we also happen to go through the current budget document and happen to see where does rupee come from, how where does rupee goes to. And then later we discuss in the second part the different types of deficits. Okay, how do we measure, what are the formulas to compute deficits, and is it good or bad to have these deficits? Okay, what's the problem of having a revenue deficit? Why do people suggest to have a revenue surplus budget or revenue neutral budget? When it comes to fiscal deficit, is it good or bad to have a fiscal deficit? Okay, so agar if people borrow money, isn't it, what should the government has to do? What proportion or what should whether there should be a limitation upon the fiscal deficits? If the government borrows too much of money, recklessly spends by borrowing too much of money, the consequences is that it's going to create inflation, and it might crowd out the markets for investments, and that's a very basic reason. We also ended up concluding the fact that there's nothing wrong in borrowing money if the government intends to spend it for a valid reason or ends up creating some capital assets, but that particular borrowing should be within reasonable limits, and that happens to be the reason why why the government has come with this FRBM Act of 2004, and which has been reviewed in 2015 FRBM Review Act. So this is something we will be discussing as part of your mains, but as of now I just want you to remember there is something called a law that prohibits the governments to borrow beyond a certain amount as part of their GDP or part of their GSDP. Okay, so now let's look at the current budget. So whatever you have seen in the past two sessions is what I'm just trying to comprehend, and before that I just want to make it clear, every time the budget is submitted by the government submits estimates for 3 consecutive years. So if you look at the 1st of February, you look at when is the budget submitted, on the 1st of February 2022. So when we are in 21-22, the budget has been submitted, and the budget is been submitted for the next financial year, that is 22-23. So this is how the budget is submitted, budget estimates. But similarly, the government has submitted an estimate for the previous year. So that's the reason the government also happened to submit the budget estimates and revised estimates for the year in which the budget is being presented, and the actual numbers, because let's say on 1st of February 2022, when the government is submitting the revised estimates, the financial is not yet complete. So that's the reason the government only happened to say these are the revised estimates for 21-22, since the year is not yet complete, because by 1st February the year is not yet complete. The government might have hardly enough information to the last quarter or until the month of December, and henceforth when would the actual numbers been submitted? After the entire financial gets completed. And that's the reason if you ever look at any budget sheet, the estimates are submitted for 3 consecutive years. For the current financial year, the budget submits the revised estimates. For the coming financial year, the budget submits it submits the budget estimates, and for the financial year that's been completed, the previous year, they happen to submit the actual numbers, because they have the complete information with respect to this year. But this year is not yet been completed, and this is going to be the coming year, and that's the very basic purpose of submitting budget. Okay, so if you look at the let's not simply, I don't intend you to by heart, I just don't want you to by heart all these numbers, but I just want you to know what exactly is the if you look at a statement called budget at a glance, that gives a clear idea of how the budget is made and how the budget is presented. So the first part of the budget do consist of revenue receipts. And what does the revenue receipt consist of? The recurring flow, that is the tax revenue. Within tax revenue, we are only just considering net to center. After simply giving it certain part of the tax revenue to the states, whatever is being left to the center, that's what this is the proportion of money the center happens to keep it with itself. And then the non-tax revenue. Then next comes the capital receipts. And then summing up both the receipts comes with the total receipts. So what are the total receipts of the government of India? If you could look at it, that's around 39,44,909 crores. Okay, so then comes the total expenditure on the revenue account. So on the recurring account, and out of the recurring account, what amount of money is the government spending upon the interest payments for this year? If you look at it, this is the amount of money the government spending upon the interest payments of this year. Then comes grants in aid for creation of capital assets. So if you look at when we compute effective revenue deficit, we need this particular number, because this simply removed from the revenue deficit gives us effective revenue deficit. Okay, so what we are doing, what the government is doing, it is simply giving the information of total revenue expenditure out of the total revenue expenditure, how much money the government is spending upon the interest payments and how much of the money is being spent in the form of grants for creation of capital assets. That's what it is simply trying to present in as two different rows just to compute the different types of deficits. One is the primary deficit, the other is a effective revenue deficit, and the last one happens to be the capital account. Upon capital account, what is the total amount of money the government has been spending? And you could see there is a huge difference between the revenue expenditure and capital expenditure, isn't it? So if you look at hardly 7,50,246 crores, but when you look at 31,94,663 crores, the amount of money that's been spent upon revenue account is much higher than compared to the amount of money that's been spent on capital account. I mean, the assets that we are creating year on year is much less relatively compared to the amount of money we are spending on a recurring expenses, isn't it? The consumption expenditure. Okay, going ahead, let's also see, look at it. So by the end of the day, if you look at the deficits, the total expenditures, this is the total expenditures. Okay, so and if you look at the revenue deficit, and how do you create? Okay, simply calculate the revenue deficit. It's the total revenue expenditure minus revenue income. So if you look at these numbers are the absolute numbers, but then what is this 3.8, 2.6, 6.4, 2.8? So you could see in the brackets below, okay, for revenue deficit, effective revenue deficit, fiscal deficit, primary deficit, you have some numbers below. Okay, these numbers indicate the absolute numbers, and these particular numbers 2.6, 3.8, 6.4, they happen to be expressed as a percentage GDP. Ideally, deficits, any deficits, current account deficits, not only these deficits in budget, even when it comes to balance of payments, the current account deficits, capital account deficits, any deficit is always expressed as a percentage of a GDP. So it has been, let's say the government intends to borrow, let's say this year the government intends to borrow, borrowings and other liabilities. If you look at the government intends to borrow around 16,61,196 crores. So if you express this 16,61,196 crores as a percentage of our GDP is roughly around $3 trillion. So if you express this total borrowings as a percent of GDP, that particular number comes around 6.4% of our GDP, and that is what has been. And if you have noticed the fact, look at 16,61,196 crores is the fiscal deficit of this year, and that exactly matches with the borrowings of this particular year, and this is what it is. Okay, so in simple terms, fiscal deficit is simply the total borrowing the government ought to make in this year, and when you look at these numbers, these are simply the borrowings expressed as a percentage of GDP, and this is how generally deficits are calculated. Okay, so on this particular is the actual number, and this is as expressed as percentage of GDP. Okay, so having seen the receipts and expenditure, now the question is, when you have a deficit, how do you simply mobilize funds to finance these deficits? There are broadly two different ways. Okay, let's not go into very nitty-gritty of everything. There are simply two different ways. One is the government could simply print bonds and sell it in the market and raise money, and this is simply what we say the government could borrow money. Or simply the RBI could buy this and RBI could finance it by printing money. RBI could simply buy them, buy the debt and simply finance that through printing money. So there are two different ways. So the government can print a bond and simply go to the market and sell it and raise money. Or the other way is simply let the RBI simply buy these bonds, or simply RBI finance the debt by printing money. But the problem is when you print money, because you know the purpose of money. Money is simply the purpose of money is to act as a medium of exchange or to facilitate exchange of goods and services. But if the money that you print is beyond the number of goods and services to be exchanged, I mean without any further increase in production of goods and services, if you end up printing more and more money, money becomes worthless, isn't it? Too much of money in the economy doesn't make any sense, and henceforth money should always be in proportion to the volume of goods and services that we are producing, and since money acts as a lubricant to facilitate exchange of goods and services, should always be in proportion to the volume or the quantity of goods and services we produce. But without any further increase in production of goods and services, if you end up printing more and more money, that might result in excessive money supply, would result in falling value of money, and henceforth that kind of financing deficit is really bad for the economy, and that's a very basic reason. The very common practice of government borrowing money is simply by raising money from the markets by selling bonds. So if you look at the current year, how the government is financing the deficits. So if you what are the ways the government happens to borrow money? So let's look at the latest this year. Out of this amount of money the government borrowing, majority of the amount of money the government borrowing, if you look at it, is through market borrowings. And when it comes to market borrowings, you have two different types of market borrowings. One is 𝗳𝗧c and the other is T-bill. 𝗳𝗧 stands for government securities. I mean, okay, instruments that have a maturity period of more than 1 year. Generally, these instruments have a maturity period of more than 1 year. I mean, borrowing for with a commitment to repay after more than 1 year. Generally, what we call 𝗳𝗧 government securities or gilt-edged securities. When it comes to T-bills, these are money market instruments wherein the maturity period would be more or less than, I mean, to a large extent would be less than 1 year. So as of now in India, the treasury bills, in both the cases, government is using simply, okay, certain instruments to raise money. The only thing, okay, the difference between a bond and a treasury bill is the duration. That's it. In both the cases, the government is simply raising money from the markets by simply selling a piece of paper. When it comes to treasury bills, as of now, the government of India sells treasury bills with a maturity period of 91 days, 182 days, 364 days. When I say maturity period, has been the government is simply making commitment to the people whosoever purchase treasury bill that you would be repaid the money along, okay, you would be repaid whatever the money I promised to you within 91 days, or you could also have, I mean, there are 182 days secure, okay, and 364 days T-bills. So maximum source of money, okay, deficit financing happens to be, if you look at very large proportion, happens to be from market borrowings. And then securities against small savings. So as I said, okay, we in India happens to have various saving schemes, national small savings certificates, isn't it? Okay, so if these particular savings of the public is what is being the government maintains as a banker that goes into public account of India, and sometimes the government would also raise this money, okay, borrow money, okay, whatever the public happen to keep with the government of India, okay. So if the government borrows money against the small savings or provident funds, that particular component happens to be the second part of financing the deficits, and then the external debt. So one thing I just want you to notice is that out of the major proportion of the debt that we happen to mobilize, a large proportion of debt happens to be internal debt. I mean money that is borrowed within India, and very small proportion. If you look at out of 16,60,444 crores, hardly 19,251. That happens to be rough, okay, less than 2% of your total debt happens to be from external debt. So that's one more important thing that you need to remember. In fact, I just also want you to remind the fact there is difference between external debt of government of India and external debt of India. So when it comes to external debt of India, it corresponds to external debt of, I mean, external commercial borrowings plus external debt of government of India. But here in this case, I am just referring to the liabilities of government of India from abroad, okay, only government of India's liabilities from abroad, and that's what we call external debt. So there is difference between external debt of government of India and external debt of the nation, that is external debt of India itself, because India constitutes its people, its the private, I mean corporates, whoever happens to borrow money for meeting their commercial requirements. Okay. And the problem is simple. Okay, in this case, I just want you simply to show the picture. The higher is the deficits, because just because you are able to raise enough money in the markets, the higher is the deficits, okay, the government maintains to meet its expenses, the more will be the problem, because the government's experience, okay, ends up mobilizing more and more debts, and these debts results in increasing more and more interest expenses, and these interest expenses are going to be part of your revenue expenditure, and that would incur more and more burden upon the future generations. And that's the basic reason it is very generally said the deficits of this particular government has to be within reasonable limits. So in this case, if you look at that picture, it says the harder you dig, the deeper you sink. Okay, the more is the money you borrow, the more is the troubles you would end up experiencing. It applies for the government, also to individuals, also to corporates. Okay, so that's what, even what comes to personal aspects, okay, it always happens to be true. The more money you borrow, the more of the troubles you are into. So that's this. Now the question here in this case, this is all about how the government finances deficit. So as I already said, one way of simply financing deficit is through printing money, and we already have seen how bad it is. The second is simply sourcing money from market borrowings. So this is what is, and all these borrowings, whatever the government happen to raise from the markets or simply through printing money, would be accounted as part of its public debt. Now let's look at understand the third major part of public finance, that is public debt. So when it comes to public debt, it's not some of your debt and my debt or some of individual's debt. It is the collective debt of the people. I mean, whatever we people collectively owe, that is what is called a collective debt. Okay. So what I mean is a public debt. In fact, it is simply the debt of governments, the debt of government of India. So if you look at the debt of the nation, okay, if you look at the India's total debt to GDP ratio, isn't it? Generally, most of the time you might have come across the debt to GDP ratio. So, whenever we happen to calculate the debt to GDP ratio, we happen to account the debt of all states plus the debt of the center's debt together is what we express as debt to GDP ratio. I mean, out of the total debt of India, what component happens to be the center's debt, center's component, what happens to be the state's component. But at the end of the day, whatever is the money that governments borrow to meet their current expenses, which ends up becoming a liability, is going to be the debt upon the public, and that's what we refer as a public debt. And this debt could be again segregated into internal debt and external debt. Internal debt and external debt. So, if you are borrowing money within India, if the money borrowing from government of India is within India, we call it internal debt, and in India, internal debt management is done by RBI. So, in India, who manages the internal debt? RBI. And when the government borrows money to meet its expenses from abroad, that's what is called, that proportional component is what we call external debt. And in India, the practice is that when it comes to external debt, it is the Minister of Finance who happens to take care of this part of external debt. So, public debt simply is the collective debt of the people of this country. So, as of now, if you look at around large proportion of it, the center's component happens to be relatively high because the center spending happens to be much higher than compared to respect to states. So, the one thing that you understand is the debt to GDP ratio, and you just need to figure it out what exactly is the total debt to GDP ratio of this country, and just compare with various other developed and emerging economies. That helps you understand what exactly the fiscal position of this country. So that's what the public debt simply does mean. It's not simply the debt of individuals, it is the collective debt of all the people. I mean, collectively, whatever we owe to the people within India, to the institutions within India, or to the people or institutions outside India, that's what we call it as a total public debt. So now we happen to complete two important topics. One is the monetary policy, and the other happens to be the fiscal policy. So and we happen to see in both the cases, both monetary policy and fiscal policy happens to at large have very similar kind of objectives. What's the objectives of monetary policy? Monetary policy tries to achieve the objectives of promoting growth and employment, and also happens to help in containing or maintaining price stability. Same is the case with fiscal policy. Even the fiscal policy makers also tries to achieve the similar kind of objectives. So they promote, their actions results in promotion of economic development, promote growth and employment, and at the same time also maintain price stability. In fact, both happens to supplement each other. But unfortunately, what so happens now? Let's look at the reason why there would always be a difference of opinion or the so between the monetary policy makers and fiscal policy makers. So if you look at RBI, which is in the job of containing inflation. So whenever there is an inflation in the economy, what do you think the RBI would be doing? The best solution for containing inflation is it keeps increasing the interest rates. Whenever the interest rate keeps going high, the amount of money people borrow and spend, the amount of money people borrow and invest happen to decrease. And when spending and investment decreases, what happens to the overall demand in the economy? That decreases. And when the demand decreases, what happens to growth rates? That obviously ends up decreasing. I mean, if you are trying to contain inflation, that comes with a cost of sacrifice of some amount of growth. And when the growth keeps falling, definitely it's the government that would be ending up blamed, and that's the reason. If you look at, there would always be a certain amount of conflict between the fiscal policy makers and monetary policy makers. The fiscal policy makers, the government will always be happy when the interest rates are cheaper and when the growth rates are higher. But the monetary policy makers, in order to keep the inflation under control, they deliberately tries to ensure, at times to contain inflation, they tries to keep on increasing the interest rates, which would not be fall in line with the interest of the government of India. That's where the difference of opinion happens to be arise between both the monetary policy makers and fiscal policy makers. And that itself is the reason, why you might have observed in the recent past the government coming with various initiatives. And one particular part of it is already discussed in the name of Monetary Policy Framework Agreement, a deal between the government of India and RBI, wherein the government of India has asked the RBI to target inflation within a reasonable limit, that is 4 plus or minus 2%. So in this, in that you might have noticed the fact that the government itself is deliberately asking the RBI, your job is to keep the inflation within the range of 4 plus or minus 2%. Never ensure the inflation falls below 2%. Don't, at the same time, please do ensure that inflation doesn't go beyond 6%. So that's how the government made it clear to the RBI that your job or your first priority has to be always to contain inflation. You target inflation. And then in the same year in 2015, the government also has come with an initiative and ended up making it clear that if you take the responsibility for containing inflation, I would simply take the responsibility of managing even internal debt. Okay, so that's what's the very basic purpose of the government coming with an idea of public debt management agency. Public debt management agency. So what is this public debt management agency? As such, I already mentioned, okay, just 5 minutes back, that in India the practice of managing internal debt is with RBI. Since RBI is the one which manages the debt, okay, and RBI is also the one which manages the inflation, which contains inflation, which many a times results in conflict of interest. The reason is, if RBI is trying to manage internal debt of Government of India, the RBI always wants to ensure the rate of interest would be cheaper. But the same RBI to contain inflation wants to keep the interest rates higher, and since that results in a conflict of interest within RBI, and many a times the government takes this as an advantage, simply borrowing money from money through RBI. Okay, so the government many a times doesn't maintain any fiscal control, and henceforth the government in 2015 has come with this proposal of simply taking out the responsibility and surrendering it to a separate agency, which is going to take the responsibility of managing both the internal and external debt. Of course, in reality, okay, due to some due to some reasons, this idea of PDMA has not yet been materialized. So the idea of PDMA is to create a separate agency by the government for the say, and what is going to be the responsibility of PDMA, the Public Debt Management Agency, is to simply take over the responsibility of managing both the internal debt and external debt. And as of now, who is managing the external debt? Minister of Finance. And who is managing the internal debt? RBI. And what's wrong with RBI managing internal debt of Government of India? Because it results in conflict of interest, because inflation management, debt management together cannot go hand in hand by the same institution. That's the very basic purpose of Public Debt Management Agency. So in this particular lecture, we happen to cover the entire fiscal policy. To understand the fiscal policy, we have seen the budget statement of the Government of India, the receipt side, expenditure side. So in simple terms, in the name of public finance, we understood the income of the Government of India and the components of the receipts of the Government of India, and we have understood the expenditure of the Government of India, and then we also happen to look at the various types of deficits of Government of India, how are these deficits are financed, and that particular part of the, okay, and those deficits that are being financed through borrowings results in incurring debt, and that particular debt is what we call public debt. Okay, and if that debt happens to be mobilized within India, we call it an internal debt, and if it is mobilized from abroad, we call it an external debt. So this completes the topic of fiscal policy, and in the next session we will try to understand various components of taxation. So taxation, in the part of taxation, so as part of taxation we will try to understand what are the major sources, I mean different types of taxes, different ways of levying taxes, and before going to taxes we also try to understand the very important concept of finance commission. So what exactly is the role the finance commission plays, and how does government mobilizes money, and how is the tax is being devolved among various organs of the government, what proportion of the money the center keeps, and how is it being distributed to the states, isn't it? So the vertical distribution and then the horizontal distribution, different types of taxes like direct taxes, indirect taxes, and the reforms in taxation in the recent past related to something like VAT and then GST, the problems related to both direct taxes and indirect taxes. Then we will try to understand the reason why the tax to GDP ratio in India is very much less, okay, why people in India do evade payment of taxes, why the tax avoidance is and evasion is relatively high, what are reasons for creation of such a huge amount of black markets and black economy in this country. So these are the things that we will try to understand as part of taxation. Okay, so and at the same point of time we also try to understand different types of taxes, okay, different taxes starting from income tax to corporate tax, what do they mean, what's the problems associated with it, and some terminology related to taxation is what we will be discussing in the next part of our series. That's a taxation system in India. That would complete our total, okay, I mean in fact once the taxation has been completed, that gives a complete picture of the entire topic, that is public finance. So I would rather suggest that public finance is not yet complete until unless you happen to have a clear understanding of issues related to taxation. Thank you.